Today, I will present an investment strategy based on an analysis of the S&P stock market that could be helpful to you. Let's look on the S&P 500's performance over the past decade. Notice the consistent upward trajectory, showcasing the market's resilience and long-term growth potential. The highlighted area marks the onset of the COVID-19 pandemic, a rare event that significantly disrupted this trend. However, such disruptions can create strategic investment opportunities. Turning our attention to sector performance during the COVID-19 crisis, we observe during the early months of the pandemic, February and March 2020 marked significant downturns across the board. This table illustrates the monthly performance of various S&P sectors, with the energy sector experiencing the lowest annual cumulative return. This was largely due to the unprecedented collapse in oil prices. Conversely, technology sector achieved the highest annual return, benefiting from the accelerated digital transformation as the world adapted to the pandemic's constraints. These insights are pivotal when considering the timing of investments. In this segment, we'll zoom in on two sectors that stood out during the pandemic: healthcare and technology. The healthcare sector, illustrated in the top graph, thrived as the demand for medical products and services surged due to the global health crisis. This uptrend reflects the sector's critical role in combating the pandemic, from developing vaccines to providing care for millions. Below, we see the tech sector's ETF XLK and its remarkable growth trajectory during the same period. This sector capitalized on the new normal, with remote work and digital services becoming integral to our daily lives. Slide 4 brings us to the sharp downturn in the energy sector, driven by a dramatic decline in demand following global travel restrictions and economic shutdown. The graph of the energy sector's ETF showing how it underperformed against the market. This was largely a result of decreased mobility and industrial activity during the pandemic. Overlaying this, we see the precipitous fall in WTI crude oil prices, dropping below $70 per barrel at the pandemic's outset. This price drop reflects the stark decrease in global energy consumption. Notice the highlighted area indicating when the stock prices dipped by over 30%, while oil prices tumbled by over 70%, underlining the sector's sensitivity to external shock. The subsequent recovery in oil prices, aligned with gradual lifting of restrictions, suggests a rebound in sector performance, yet it also calls for a cautious approach given the volatility involved. This slide illustrates the profound macroeconomic impact of the COVID-19 pandemic. At first graph, we observed a fourfold spike in unemployment, reflecting the immediate shock to the labor market. Concurrently, the consumer price index initially declined, mirroring a drop in consumer demand. However, as the pandemic progressed and economic activities resumed, the CPI experienced a significant rise due to tightened labor markets and supply chain disruptions. In response to these challenges, central banks and governments across the globe rolled out extensive monetary easing and fiscal stimulus measures. These efforts were aimed at cushioning the blow from the pandemic and spurring economic recovery. We see a correlation between these policy measures and the subsequent increase in the stock market. It illustrates the lag effect of macroeconomic policy and its influence on the market, highlighting the importance of timing when adjusting investment strategy. Investors should note the dual-phase market response, an initial downturn followed by a recovery, often fueled by policy intervention. These insights are critical when considering buy and sell strategies, especially in the context of zero interest rates and potential upcoming rate hikes.